In our Monday preview piece, we highlighted the fact that monetary policy and yield differentials would be taking a backseat as a driving force behind movement in markets, with global trade wars heating up. And shortly after publication, things intensified in this direction, with the yuan sinking to a record low in reaction to the latest round of U.S. imposed tariffs on China. The outflows from China are less about any official moves by the government of China and more about a massive flight to safety amidst turmoil, with investors wanting to get out of the Chinese currency as quickly as possible as risk liquidation themes intensify. News that Chinese authorities had asked state buyers to halt U.S. agricultural imports only added insult to injury and was just something to layer on top of the China outflow. We've talked a lot about the U.S. administration's strategy to push for a weaker U.S. dollar in order to make for a more competitive currency with its trading partners and to ultimately help rebalance the U.S. economy. The administration has been at odds with the Federal Reserve given the central bank's unwillingness to accommodate this strategy, and President Trump has responded in kind by way of last week's tariffs, which have resulted in a dollar weakness against the major currencies, while also now putting a lot more pressure on the Fed to bend to the administration's will by needing to cut interest rates yet again, something which the Fed will be needing to think about a lot more seriously as the U.S. equity market tumbles. And yet, this capitulation in the equities market has been long overdue after a decade of unprecedented emergency low-level rates and government stimulus designed to artificially fuel stocks to record highs in the hope that this would bolster sentiment and trickle down into the real economy. While this strategy may have been necessary, it was never going to be a foolproof one, and the fallout from the 2008 crisis that was never really seen is still waiting to play out. But all of this should be viewed as a necessary step to help get things back to where they need to be, which is a place where markets are no longer so correlated to central bank policy and are more free-moving and efficient as they once were. As expected, the dollar has been hit hardest against the alternative traditional safe havens, with gold at the top of the list and the Swiss franc reluctantly behind. Of course, the yen has also appreciated on the traditional correlations, while the euro is absorbing a lot as well. Even the pound is higher on all of this despite ongoing Brexit worry, perhaps also getting a boost from the better-than-expected UK services PMIs. That's all for now.